Hi, my name is Stuart Weems and I'd like to take you through this presentation to show you how to invest in property using evidence-based approach. And I'm going to use or share with you four very simple, very important charts to demonstrate how this evidence-based approach works. See, I think most Australians that invest in property fail to generate really good returns. That is, that their properties are generating very average returns, and there's a fundamental reason for that. There's something wrong with the particular asset or asset selection or the way they've gone about choosing that property. And it's not subjective. It's not throwing darts at a dartboard. There's a fundamental process to follow, which I'm going to take you through in this video. Of course, this is just general information. Don't act upon it until you get your own advice. It's very important. Okay, the first point that I would like to make is that it's all about the gearing, not really about property. So gearing means borrowing, and the reason that property generates good returns is because we tend to borrow a large amount, typically 100% of the cost, in order to invest in that property. So our capital contribution, the amount of money we put into the asset, is really limited to the holding costs, meeting the shortfall between rental income and interest expenses associated with the loan. And with that gearing, if we borrow to invest, it really magnifies the returns, both negative and positive. And as this chart shows, what I've done is had a look at what are the contribution to total returns. So, for example, if I go and invest in property, my internal rate of return, my total return over a 25-year period, net of all taxes, is about 14%. But what has driven that 14% return? Well, we can see capital growth is the lion's share of it. 7.64% has really come from the improvement in the value of the asset. We've lost a little bit in tax. Of course, we enjoyed some negative gearing in the earlier years, but the capital gains tax reduces the net return. Rental income's only contributed 1.65%, and the reason for that is that property tends to have, large expenses associated with it. So it's not really an income asset. And gearing has contributed over 6.5% of the total return. So if we take the gearing out, our returns wouldn't be that great. So when people think about should I invest in property or should I invest in shares, a much better way of framing that question is really about should I gear or should I not gear? So if I'm happy and comfortable and it's appropriate for me to borrow to invest, then property is probably the best answer. If you don't want to borrow, so you don't want any borrowings associated with your investing, you're probably better off investing in the share market. So people always think about property versus shares as in which is the better investment. It's a bit of a silly question. They're both very good asset classes and you can build a lot of wealth investing in either of them or both of them. It's really about should you borrow or should you not borrow, and it's the borrowings that are driving most of the return as long as I'm investing in an investment grade asset, which I'm going to talk about in a second. The second point that I'd like to make with this second chart is that you need to hold a property long enough so that you enjoy one flat cycle and one growth cycle, or two flat cycles and two growth cycles. Whatever it is, you need to have as many growth cycles as you do flat cycles. Now, what do I mean by growth cycles and flat cycles? Well, this chart looks at the change in median house price in each of these capital cities since 1980. So over 40 years worth of data here. And what it shows is that quite often markets go through two cycles. There's a growth cycle, and a growth cycle is tend to follow by a flat cycle. And we can see that the long-term returns are around about 7-8%, close to 8% in terms of long-term returns over that 40-year period. It's just that it's not straight line. You don't get that 8% every single year. And particularly Sydney and Brisbane in particular, Melbourne, you can see, had quite a protracted growth cycle from 97 through to 2016, which is a bit unusual, but all the other growth markets, all the other markets, property markets, have a flattened growth cycle. That means that if you purchase a property just before a flat cycle is about to begin, you need to hold that property for much longer in order to generate average returns, so the 8% compounding. And remember, you don't need a huge capital growth return. As long as you get more than 7.2% compounding over a very long period of time, on average, your property will double in value every 10 years. So you don't need to aim for 10% growth. Anything more than 7.2% growth will be more than enough. But you must understand that property markets, even good quality, great quality investment grade property, moves in cycles, and it's not unusual to experience a period of 5 to 10 years of a very flat cycle. And you look at Perth there, it's had an even longer than a decade period. The next chart that I'd like to share with you is to demonstrate that it's all about the growth, not the income. Often people think choosing an investment property is really about choosing a property that's going to generate a strong amount of income. Unfortunately, that's just not true. It's all about the capital growth. So on the left-hand side of the chart, I've got a property worth $750,000 that's generating a 5% rental yield and 5% capital growth, so total return of 10%. So you can see when we first buy that property, it's worth $750,000. Rental income is $37,500. By the time we get to year 40, the property's worth $5.2 million and $250,000 of rental income. Now, these numbers are hard to get our head around. As human beings, we find it hard to really understand how figures compound, but just bear with me. The right-hand side of the chart shows the same return, same total return, 10%, but in this situation, we get 2% of a rental yield and 8% growth. And so again, our starting point is $750,000. We're only getting $15,000 of rental income, so half the rental income. Now, people looking at those two assets would go, well, of course, I want the one on the left because it's generating a higher income. But then let's fast forward in 40 years' time. I know it's a long sort of time period, but even over 30, in 40 years' time, it's worth $16 million, so $10 million more, or 3 times the value of the other asset, and it's generating more income by that point as well. It shows that compounding capital growth does all the heavy lifting, and the reason for that is that income is taxed each year. Capital growth is not, of course, not until you sell the asset. The benefit is you get to reinvest that 8% each year, and it compounds each year, and if you hold it for many decades, as you can see, if you hold it for 20 plus years, that compounding in dollar terms really starts to make a big difference. Look at the difference between 20 and 30 years. We're talking about $4 million. So again, it doubles the amount of equity that you have in that property just by holding it a further 10 years. It's all about the capital growth. So if it's all about the capital growth, what we then know is that we must hold a property for many decades to really enjoy the huge compounding impact. So what this chart does is chart a $750,000 property that is growing at 7.2%. Remember, the long-term average across major capital cities is higher than 7.2%. So we're only looking at sort of median growth here. In the first decade, your property's worth $1.5 million. You've got $750,000 of equity. In the fourth decade, as you can see on the right-hand side of the chart, the property has grown from $6 to $12 million. You've had $6 million of equity growth in that fourth decade. So really, you've got multiples, many times the dollar value growth than you got in the first 10 years that you own the property. And what this chart is showing is that the compounding nature of property and compounding nature of growth is that holding a property for 10 years is great. Holding a property for 20 years is better, but it's really beyond that 20-year period, that's when you're going to get huge dollar value compounding capital growth. Now, you can imagine if your property is increasing in value by $3 million over 10 years, so let's say $300,000 a year, you're not spending $300,000 a year. If you own this one asset that's such a great asset, and even if you're spending $100,000, your overall wealth is still accumulating and compounding. Okay, and my final chart is really to demonstrate there's 3 attributes that a property must possess to be considered to be investment grade. An investment grade property is going to generate most of its return in capital growth and proportionately less in income. So it's very much going to perform like this chart is demonstrating. And there's 3 attributes that it must have. The first one is a persistent imbalance between supply and demand. Of course, when an asset is in very high demand but finite or fixed supply, that's when you tend to get price appreciation, because there's more and more people that want to buy that asset, and then there's more and more people that can afford to pay more. So blue chip suburbs that have very little access to any vacant land in any close sort of proximity. Architectural style, if you compare, for example, a block of 200 apartments, they're all the same and they look all the same. The floor plan's the same. Whereas if you look at a sort of Art Deco apartment that's in a block of 6, no one's building Art Deco anymore. It's in very finite supply. And you need to invest in an area where the demand is strong and the demand is underpinned by people that have access to financial resources that they're always able to pay more, whether those resources are higher than average incomes, inheritances, stock options, gifts from family, these sorts of things. You don't want to invest in a location where it's linked very closely to incomes, because we know incomes over time just can't keep pace with that level of growth. You want that area to be dominated by people that want to live in that area that have other resources. The second attribute is past growth. The reason why past growth of a particular property asset is relevant is that growth drivers tend to be both static and factual. So static, I mean they don't change very much, and factual is they're a question of fact rather than a subjective assessment. So for example, if I'm looking at a particular suburb, I know how far away from the CBD it is, what sort of hospitals are close by, what sort of public schools are close by, the amenity in the area, all those sorts of things. Those hospitals, schools, shopping strips, transport, arterial roads, all those sorts of things are a question of fact. They're just not my opinion. And it's likely they haven't changed for many decades. And they're the things that have contributed towards that property's growth. So then if I am interested in buying a property at 13 Smith Street, I will have a look at what has 13 Smith Street been bought and sold for over the past 3, 4, 5 decades. And I can calculate then what its capital growth rate is. I can then look at next door, 11 Smith Street, and the other side, 15 Smith Street, and I can, if they're comparable types of properties, I can look at what they've grown for, and I can look at 14 Smith Street across the road, for example, and it starts to build a body of evidence around that particular asset and whether it actually has the attributes and the fundamentals to drive growth. Because if the past growth rate has been really poor, then it's a higher risk investment, because what I'm doing is I'm assuming that past growth isn't indicative of future growth, but unfortunately it often is. The third attribute is a very strong land value component. So a property's total value is made up of 2 items. Firstly, its underlying land value, and then secondly, any improvements on that land, so the dwelling, of course, which we call the building value. We know that buildings depreciate over time and land appreciates. And so the stronger the land value component we have or can have, the more, the higher the attributes that property has, the more chance it has to generate really strong compounding capital growth. And so what we want is more than 50% to be in the land value, because we want that land value to really push the overall value forward. And so for a house, that's relatively easy. For an apartment, that's typically going to be an older style apartment on a very large block of land, as compared to a new style apartment. Tends to have very, very low attributable land value. So they're the three attributes that we want to have to make sure a property is considered to be investment grade. In terms of investing in property, we know that we've got to hold the asset for a long period of time. We've really got to focus on the capital growth rate. We know that borrowing to invest in property is really the thing that makes this strategy work. And then if we buy an asset that is considered to be investment grade that has all these three attributes, chances are, and we hold that for many decades, we're going to do very well. Now, if you want to learn more, I write a weekly blog and podcast. You can subscribe to that. There's a link in the description to this video, and I hope you've enjoyed this presentation. Thanks.